to manage how we can manage our finances in retirement, especially if we are retiring with no pension, and how do we generate income during retirement with the corpus that we may have. Also, with this kind of analysis, what insight does it provide us in terms of if we are still in the phase, and I think most of us are still in that phase where we are, you know, probably in our mid, in our 40s or 50s, and we are now, retirement doesn't look that far as it used to look, when we started working. So what insights do we get in terms of how do we prepare our retirement corpus in preparation for retirement? Okay. So some starting assumptions that we are doing is, um, so we're not getting into how we got to retirement corpus, but we're assuming there is some retirement corpus, and that this is the retirement corpus that we have to use, or the portfolio we have to use to generate the income. Okay, so those are the two assumptions we are starting with. Okay. Now, typically, and I have done this, trying to go to either to some advisors, or even, if you see, there are huge number of articles that get published, right? Advice that get published. And most of these advices that I have seen are very, very high level, generic, and really do not give us anything to really work with, right? So most of it is, okay, takes, if in India, senior citizen scheme, PMVI Vandana Yojana, take some pension, and basically then have some kind of systematic withdrawal plan from your mutual fund, a debt fund, or some balanced fund or something like that, right? But there is no mention of what happens, does can it in terms of sequence, or even to how to essentially operationalize it, right? We have all heard of bucket theories and other theories, but there's no mention of, or there's no details available or tools available to say how do you actually operationalize it, and does it actually work in practice. Okay, some testing has been done to see if it actually works in practice, and that's what I'm going to kind of start sharing it. But we'll start with some basic uh, concepts, and then I'll get to whatever testing I have done. Okay. Now, I think these are kind of obvious, but just to reiterate, what worked in pre-retirement, or what works now when we are in accumulation stage, right? If you're still earning, will not work or may not work in post-retirement, right? Today, the focus largely for us is to grow our wealth, right? If we are in a pre-retirement stage, it's largely to grow wealth. We keep looking at our net worth as to where the net worth is growing, how much it is growing, and that portfolio, or that corpus that we are building, we are not looking for that corpus to generate income for us, because our income is coming from somewhere else, right? Whether it is a salary or business or whatever we may be doing, income is coming from somewhere else, and we are just focused on the growth of it, right? But once we get into retirement, and assuming we kind of stop working for money, then that corpus has to now start generating income, and therefore our focus will shift from growth to income and capital preservation, right? And we all know it's not easy to see the portfolio value go down, even when today, when you really are not dependent, when we are not dependent on that corpus for our daily lives, and to put food on the table. Even at that time, when we get so worried and anxious to see our values go down if the market is not doing well, imagine what happens when that is the portfolio from which is going to put the food on the table, right? So if you think today people are not, they start thinking about stopping their SIPs or withdrawing money from the market because market is down. What happens when that's the only money you have, and from that you have to generate income, right? And essentially, without a plan or structure, the fear of unknown, because I don't know what will happen and what may happen to my portfolio or corpus, will act as a hindrance to enjoy retirement, right? A lot of people now look to retire and they have plans. Okay, I'll do things that I've not been able to do when I was working because I didn't have the time. But if there is a fear of I don't know how much my money is going to last or what will happen, then you're unlikely to be able to do all of those things. Okay, so I mean, any points, any questions anybody has, or to make, you can join in. I'll move. So that brings us to kind of what are the key questions, right? Obvious one: do I have enough, or how much should I have? And then, will this last my lifetime? Right? With the money that I have accumulated or the corpus that I have accumulated, will it last my lifetime? What should be my asset allocation? How much money can I actually spend without running out? What happens to inflation? So how do I address those kind of questions, right? So obviously in this session, we're only talking about the financial aspects of retirement, right? People who, if you have parents who have retired, or the biggest problem for them is not money, it's time, and what to do with the time, but that's not what we are addressing here. So as I said, there is a lot of research available, and this is academic research and financial analysis research that is available, and that research largely focuses on what is the probability of success and failure, or probability of failure. So they look at various scenarios, various asset combinations, various withdrawal rates, and try and find basis some simulations what gives you the highest probability of success or the lowest probability of failure, right? Uh, Obviously, uh, unless you're really drawing down much less than what you should or could from your portfolio, pretty much it's impossible to get to something that will give you a 0% failure or 100% success. So when we say success, what do we mean by success is essentially that our retirement corpus outlives us, so we don't run out of money, and we don't leave more money, um, for our children or whoever we want to leave money for than what we had planned. Okay, so the basically saying that okay, there's no joy in dying rich. Okay, unless you plan to and you live like a pauper through the life, but you die rich. So you die with a lot of money that you leave to your children or whoever else, but you never enjoyed that money while you were alive. Okay, so so even that would be kind of deemed as a failure if you, right? Because from planning perspective, you could have done more with your money than we actually would do, and essentially then the whole point of this is to enjoy retirement as we had envisioned, as we planned to. If we had planned to travel, if we had planned to do something, then yeah, those years you can do, right? And however you wanted to live, that way you can live. And how do we then essentially maximize the withdrawal or maximize income out of the corpus that we built? Okay, just let me know if I'm going too fast or too slow, but I just wanted to cover a few basics and then we can get to.
Just one point, Rajal.
Yeah.
I can't see anything on the screen. Are you sharing something?
Oh, you're not seeing? Yes, I'm sharing. I can. I am actually having.
Yeah, we can see.
Oh,
We
Rajal,
have.
we can see.
Okay, let me then dial out and dial in again. Okay.
Yeah.
Yeah.
Because classification or asset reclassification largely from a retirement angle point of view, right? So I think one thing from an asset perspective, when you look at in retirement, is whether it is a long-term asset, short-term asset, whatever asset you want to call it, largely, um, you know, it is, largely it should be liquid, right? It should be something that you should be able to liquidate at, you know, almost on demand, right? So that it generates, if required, if for unseen expenses or whatever, or even for your monthly expenses, it's like a systemic withdrawal plan or something you're going to have. It's only possible if that asset is, uh, can be liquidated and can be liquidated in parts. Okay, so we look at in terms of what are cash. So there's some cash and cash equivalent assets. So essentially, in retirement, we would need to have, you get comfort from having some of cash available at which is not linked to anything happening in the market, whether it is interest market or equity market. So something like a bank deposit or breakable FDs, maybe even gold, and how much cash you should have, again depends on how your other things are. But I would say at least about a year's worth of cash, years worth of expenses or income, we would have should have in as a bank deposit or a FD, so that you're not dependent on what happens in the market. Probably even more, maybe 2-3 years worth of money should be like that. Then we look at hybrid, right? Again, in hybrid, we're looking at really conservative hybrid or a balanced hybrid, not more than 40% equity, right? And anything more than 40% equity should be treated like an equity, right? And again, largely we recommend to have index fund or large cap index funds or large cap mutual funds, maybe some aggressive funds, aggressive hybrid funds. Stocks, I leave it to for people to decide, and especially in retirement, we would think they should avoid any mid cap, small cap stocks or funds, because essentially simply because they're too volatile, and the focus for us is now not growth but really conservation. Okay, then an important part of our assets in retirement would be something that generates income for us. Okay, which could be either in the form of bank, FDs, bonds, where you get interest incomes, could be stocks where you get dividends, real estate where you get rent, could be any pension scheme, insurance schemes, or if you're a government employee, or wherever you get pension from, right? So some income generating assets would help. And then we have, you may have some illiquid or dead assets, assets that are difficult to liquidate, that do not generate any income, but it's valuable, but only on paper, and not really until we can convert that into something that generates income. So one example could be a plot of land that is sitting somewhere, right? Now that plot of land could be worth 5 crores, 1 crore, 10 crores, but is is not useful until you generate some income out of it, right? If you don't, either if you don't sell, or uh, you're not generating any rental out of it or whatever, it's just sitting there and probably more of an expense than really of any value directly. Okay, so if you look at what we want or what we desire and what actually is happening, right? So more and more people want, you talk to anybody, nobody wants to work till 60, right? People want to retire at 50, depending on what your current age is, you want to retire in the next 5 years, generically speaking, right? So if you are in your 40s, you want to retire by 45, 50, and, so nobody wants to retire at 60. Everybody wants to retire much before 60. But the reality is, more and more people are actually having to postpone their retirement. Okay, they're having to work longer, and they're retiring later than before. I mean, if you and this is for various reasons, and largely because people are not saving enough. Cost of living has been going up, and whether it's in the West, or even in India, I think people are having to work longer unless you have actually worked for it, before. People, we think expenses in retirement will decline, but actually what happens is they actually go up, at least during the initial years of retirement, right? Now, especially let us say if your eventual place of retirement is different from where you're currently living, it's obvious that for the next, one, if you retire, you move to a new place, you'll have establishment costs, right? Unless you've already maintained a retirement home. And in general, in the first few years of retirement, you would want to, people want to travel, they want to go to holiday, they want to do things that they've not done before. So generally speaking, your expenses typically actually go up rather than going down, right? At least for the initial few years, it actually goes up. And then, if you talk to most people, especially people who are in their 40s or even I don't see myself living beyond 80, 85 because that seems too long, right? From it's another 40 years. Who wants to live? But the reality is that life expectancy is going up every year, right? And in a way. So if one, what I would say is if your parents are still alive, or whatever your parents' age, grandparents, you should add another 5 or 10 years to whatever they lived for, right? Because that's what you are going to most likely live for, because we have access to much better medical care and everything else than our grandparents had, right? Or people generally had. So life expectancy is going up. So basically, that means that we'll end up spending a lot more time in retirement, right? Than they had to do. Okay. So generally, what are the threats that we get? Obvious ones: inflation, medical expenses. As you grow older, medical expenses and can happen. Market downturn, or essentially, let's say, sequence of returns, right? Sequence of returns is a huge threat on, as we will see when we get down, on what happens actually during retirement, right? For that money and any other unexpected expenses that may come, right? I mean, you have, when life doesn't stop, um, things happen, right? And then expenses do come. It could be home repairs, it could be anything, right? Okay, so see, broadly speaking, if we go and do, across, research across what is advised, these are the kind of strategies that are typically, advised, right? So one is, I think some of them are very famous, like 4% rule kind of has become a thumb rule. Everybody thinks that 4% rule works, and just if I have a crore of rupees, then I can easily get 4% of that, 4 lakh rupees a year, easy, and I can, and that will keep up with inflation and can keep taking out 4% every year. So we'll see whether that
So
actually.
Rajul, one question.
Yeah.
How much you said at the age of 60, how much we should have if we need to live till 80, 85 with
I,
the
I haven't I haven't
interest
said
rate
that.
of
Okay, so
4%?
that we will get to, right? Because
Okay.
that kind of depends, on many things, and especially, let's say, one big factor on that is what do you think is going to be your expenses, right? So that answer is different for different people, right? What I'm saying is don't plan for 80, 85, you should plan for 90, 95. Okay. Uh, 80, 85, nothing's going to happen. Okay? Unless you are really some critical illness happens or something bad happens, right? I mean, in a normal scenario, people are not dying in 80, 85 now, right? Okay, so quickly we'll just go through these strategies. So 4% rule, fixed rupee withdrawal, fixed percentage withdrawal, income withdrawal, buckets. I think a lot of people we hear about bucket theories, right? So just quickly look at that, and then, right? So fixed percent withdrawal essentially says that, okay, I decide, okay, I'm going to withdraw 4%, 2%, 3%, whatever is in my portfolio every year. And and that's it, right? Um, so I don't have to worry about anything. So simple strategy. At the beginning of the year, I'll see what my retirement portfolio is. I'll withdraw X percentage of that, whatever I've decided, and then with that money, I will live that year, and then अगले साल का अगले साल देखेंगे. Okay. Now, so obviously, as it works, if the market is in your favor, you will get good money. If there is, if the market went down, then you will get to spend less. And unless your predetermined percentage is too high, typically you don't run out of money. Only problem is that your expenses would vary a lot, or your income would vary a lot. But you kind of don't fall into the problem of running out of money because you're always withdrawing X percentage of your available portfolio. Okay. Then a fixed rupee withdrawal essentially says, okay, I decided I need 12 lakh rupees a year, so I'll just withdraw 12 lakh rupees a year. That's it. Uh, Obvious problem with that is that that over time money keeps loses value. Inflation, it is not keeping up with inflation. So what if 12 lakh is good enough today, 12 years from now that 12 lakh is not going to be enough, right? And if the fixed amount is too high, then also we may run out of money. Okay, so that's the problem with that fixed rupee or fixed dollar withdrawal kind of thing. Another option is, I think this is option that a lot of people want to do, is to live off income, right? So I have created a corpus. Now from that corpus, or that portfolio of assets, I want to generate income, and I don't want to draw down from the corpus itself. So I started with say 5 crores, and that 5 crores should remain. Whatever income is coming out of that 5 crores is what I will live on. Okay. Now that income can come from interest, dividend, rents, pension, other income streams. The challenge is that that income may not keep up with inflation, right? And a lot of that income is also actually volatile. Um, for example, dividend is easy to understand. This year you get dividend. Next year, whether you will get dividend, whether your stock will pay dividend or same amount of dividend, you don't know, right? Rental, again, rental looks like a good thing, and generally, it is something that we look for because you get every month and you have expenses every month, so it kind of ties up. But you get one is the rental yields in India are very low, so which means you need much higher corpus. So in general, the income yields are low, right? Whether it is interest or dividend or rental or any of these things, we're looking yield from 2% to maybe 4, 5%, 6%, and that may not be enough to kind of keep up with inflation. And then there is income volatility as well. But this is one other strategy that a lot of people want to kind of use. Um, then you have this 4% withdrawal rule, which has been, which is kind of the most famous rule, if you want to call it. Essentially, it works on uh, um, basis that we can withdraw 4% of the corpus, right, adjusted with inflation. So if I start with kind of 5 crores, then the first year I can get 20 lakhs, and then every year it can get adjusted for inflation, and I can keep withdrawing that money, and essentially I will not run out of money, right? Now that 4% withdrawal rule kind of assumes a 60-40 equity debt ratio or a 50-50 equity debt ratio, depending on where you read it. But it assumes an retirement period of what 30 years, which is not bad, 60 to 90 kind of thing, and that income is generated, both that 4% is generated from income that is coming from the corpus, plus also dipping into the corpus. So essentially over time, the corpus is going down, right? The only plan is that it should not go down, below zero before 90. But it will go down, or it will start to go down at some point in those 30 years. So can I depend on this 4% rule? As we'll see later, we cannot, and not blindly anyways. Okay, so you have to go in with open eyes. A success of that rule kind of depends very heavily on what kind of asset allocation we start with, what is the inflation that we're looking at or assumption that we're putting into it, and what sequence of return we will get when we are in retirement. So largely, kind of a lot of it depends then on your luck. Okay, so for example, let's take these two sequence of returns. Okay, in the first one, we get both years is a plus 10%, right? So the average is 10%. In the other one, the first year there's a minus 30%, but the next year it goes plus 30%. So average is actually 15%. Now, which of the two is better? Any thoughts?
First one.
Yep, first one.
First one, consistent one.
Yeah, but consistent, right? But also mathematically it is better. Okay. If you look at it, the year one, right? The second one, right? Is actually only giving you an overall 12%, total over 2 years. Okay. So while the average looks 15%, but this, if you want to call it CAGR, right, or whatever. So if you started with 100 rupees, at the end of year two, you will only have 112 rupees. Okay, because of this year one, year two. Whereas in the first one, you started with 100 rupees, we'll end up with 121 rupees. Okay. So therefore, the average, so this only trying to put to picture that the average, right, actually hides a lot of things. Okay, and we cannot always depend on the average itself. The average here is 15%, much better than the average of the 10%, but that's not the right thing to do. Now we'll quickly just look at the bucket system. So traditionally, the advice on the bucket system is that we should split it into kind of three buckets. First bucket should cover for the immediate 3 to 5 years, so largely in a cash equivalent kind of assets. Then the next 3 to 5 years, you put the money in a bond, slightly more longer term assets. 3 to 5 year for the next 3 to 5 years, and the remaining you put it in equity funds or aggressive funds. Okay, that's what traditionally we are told. Okay, so therefore, if you go and somebody will tell you, okay, what should I buy? So okay, boss, for 3 to 5 years, you buy some liquid, some short-term debt fund, or put money in a bank FD. For the second bucket, you can go for a hybrid fund. Okay, and for the this one, you can go and buy a long-term fund. That's essentially the advice. Kind of it splits down to. Now, the problem with that advice is, okay, this bucket is not only to be done at the beginning of the year, beginning of retirement. Right? This bucket, it has to be there. It has to be, the buckets have to be kind of refilled every year. Okay. So the first bucket, which is the immediate 3 to 5 funds, at the end, let us say if I decided I will have cash for next 3 years. At the end of first year, now that bucket only holds money for the next 2 years. Okay, so I need to refill that. Where do I refill it from? Right, I have to refill it from one of the other two buckets, right? And immediately you will understand the problem there now, right? If the other two buckets, I have put money assuming this is a long-term thing, because in most people's mind, 5 year is long term. Okay, a lot of people think 5 year is a very long term, that is not, because at the end of first year you have to liquidate something from that, okay, to create the other, so that the other bucket is filled. Okay, so that what makes the bucket system um, kind of more difficult to implement, right? So theoretically it sounds good, it is good, it actually helps us do many things which others strategies will not do, but it is also difficult to implement. So for example, in a bucket system, because I have now cash for next 3 to 5 years, at the end of the first year, if the market has been really down, okay, market has been not doing well, I can postpone that refilling. I can say, okay, let me look at for another 1 year, I will postpone it. Okay. So I have more control over when to sell my investments, okay, depending on what's happening in the market. Okay. And it has also the potential to grow your investment balance over time because of the way you can manage this. Okay. But as I said, it is easy to understand, difficult to implement, and the biggest risk here is essentially our emotions. Okay. So how do you balance your emotions? So when, at what stage, for example, in the example I gave in terms of, let's, if the market has been down, or we'll say, okay, wait. How long do you wait? Okay. Now, or conversely, if the market was phenomenal that year and I got much higher returns than what I thought I um, would you take out those profits, and where would you keep them? Or would you wait and say, no, no, the market is still going up, it'll keep going up, right? That's what kind of happens when the market goes up. We think it will always keep going up, right? So at what stage do you take the money out? When do you book profit, not book profit? And that is where um, I think it becomes difficult in that way to implement, unless you are very, very, unless we are very, very disciplined about it, right? And it just kind of works on an automated trigger fashion, that if this is the condition, this is what happens. I don't care, and no emotions coming into it. But easier said than done for any of us. Okay, so let's get to the. So what I've done is I've tried to kind of do some testing of it. So I built some Excel sheets, and we'll go through this to each of these strategies. How do they test, and then from that testing, what kind of insights that provides us.
Rajul,
Yeah.
hello.
Yes.
Can I come?
Yes. Yes. Please.
See, Manish here. See,
Yeah.
Rajul, issue is two, three issue. Uh, one is the risk. How much risk, kind of risk you're looking for the earning. Okay, that is one part. I think as a team, we should all kind of people are there. One is the who purely want to do minimum risk and play this earning game post retirement. Second, medium kind. So I request you to find that. That is one part. Second part is if you look at the way market is behaving last 5 years, I feel it you can't be depending on that earning. It has to be a very 80-20 kind of ratio. 80. This is my feeling, which I. Uh, so you please give a thought on that. 80% has to come from, as you said, from the reliable.
Yeah. So so that's what I'm going to do now. So and just so good points, and hopefully, when we get to this testing, and that will kind of help address the.
You are testing both.
So no, yeah. Most things I have testing. I'll show it. See, on your first one, in terms of risk appetite, okay, I can tell you. I mean, there's another way to kind of define risk appetite in terms of in terms of post retirement. Okay, so in the pre-retirement, we will define risk as saying risk appetite as saying, okay, how much downturn, by how much, if my portfolio goes down by 20%, 30%, I'm okay, right? But I'm looking for an up, this thing, or I feel bad if it goes down by more than 10%. So that's the kind of risk appetite we think about in terms of, in during our accumulation phase. But I think if you're in retirement, probably the risk appetite um, would be very different, or the definition of the risk appetite probably would be different, which would be saying, as we go into this, I said each of these strategies essentially you have to bring down to what is the probability of success or probability of failure. Okay. Now, and that should decide, that would kind of decide, saying, okay, if you think you have a higher risk appetite, then you're okay with a strategy that gives you 80% chances of success. Okay. Or 90%, or are you really looking for something which will give you 95% chance of success, right? Or 100%. 100% would probably become very difficult, but you know so something of that, it is how I would define risk appetite in this, in the post retirement phase, right? So what is your risk appetite to, uh, right, from that perspective? Make sense?
Yeah.
Hmm? So let's look at. So we will now in the next. I know we are already 1 hour, but um, we try and finish this today. Okay, if that's okay with you. So we put a test scenario. We say, okay, this is test subject. Somebody retiring at 60 is going to live till 90. He retires with a 5% corpus, a 5 crore corpus. We've assumed an inflation of 7%. Okay, so let's say his desired income at the beginning of first year is 20 lakh rupees, and it keeps going up. Okay, and it keeps going up as you know with inflation, right? And for purpose of this testing, we have essentially used only two asset classes. One is equity, where I have taken Nifty 50 as the representative of equity, and for debt I have taken bank fixed deposit as debt, right? Largely. And also, in scenarios I've tried to include income, right, to see what difference does the income make, in terms of uh, probability of success. Okay, so if I had some income assets, what how does that help? So I've kept income assets outside of it, because so whether it's your real estate, pension funds, whatever, that's income. Okay. So just quickly, so for equity, I've used a bootstrap method, essentially Nifty 50 TRI index, and taken rolling returns from 30th June 99, because only after that you have, the Nifty numbers are more um, reliable. Okay. And for bank fixed deposit, it's taken as, starting at 6.25, and that goes up and down by 0.25% every year. We can change it. Okay. So just to get some randomness to the FD also, because FD rates also keep going up and down. Okay. So if you test the fixed income withdrawal, okay, so this is what we desired. Okay. This is the obvious one, desired path, right? Right? But fixed income meaning, I'm withdrawing a fixed percentage every year, and as you can see, I mean, this is huge variation, right? It's some, like, if you see this line, at some age at some point it is very much higher than what I really wanted that year. So maybe that year I went around, and I went abroad, and I had a big tour of the world, but following, years, then now I can't even, I can hardly sustain myself. Okay. That's the problem with kind of fixed percentage. It just, the variation of it will keep going, will happen a lot. Okay. Then you have a fixed income withdrawal, right? So that's what we discussed. So, we're just drawing some fixed amount every year. What happens is, and anything, so if my income is more than what I needed that year, that money is reinvested. But I only use what I needed for that, what I planned for that year, and I don't, even if my income is so here, even if my income is more than what I required, I don't use it. I reinvest it. Okay. So if you see, for various scenarios, it can keep up with it depending on our luck and what happens in the market and everything else, but or how the interest rate go. But at some stage, their income will not be able to keep up with inflation. Okay. Now, whether that happens in 5 years' time, 10 years' time, 15 years' time, 20 years' time, but it is bound to happen that your income will not be able to keep up with inflation, especially as we discussed, most income assets that we have do not generate income that keep up with inflation, right? Pretty much nothing does. Now let us look at so this is the main one in terms of the failure probability when you're looking at different withdrawal rates and a different asset allocation, Manish, to your question, okay? So we again just to
Yes.
remind, so 60 years age, 90%, 90 in expectancy, 7% inflation, 5 crores, and we're doing, like, I've done 1,000 runs, 1,000 simulations for each of these numbers that you see. So different asset allocation starting from 100 debt, zero equity, to down to zero debt and 100 equity, and let's see what it gives us. Okay. So where we're looking at a 4% inflation, 4% withdrawal rate. Okay. Remember, these are failure probabilities. So, if you see here with the 4%, essentially looking at an income of, about 1.6, 1.67 lakh per month. Okay. And, obviously with debt, you 100% fail. It will not work. Okay, because you don't have that. So typically you don't have that kind of return with that anyways, right? 4% withdrawal and 7% inflation, debt cannot keep up with that. Okay, and as you see, you can go down, and we see that yes, at some stage, it's for some thing like this is good, right? So beyond this, 30, 70, so for 100% equity, it still is very high. It could be very high, depend again on your risk appetite, whether 24% failure is something that is okay. Okay. Uh, Now, if you see at 3%, if you bring it down from 4% to 3%, then as you would expect, your failure probabilities would go down, right? And again, for 100% debt, it is still very high, but it goes down to about 5%, 7%, 8%, right? Um, at some levels, right? And most people would think that a 5 to 8% or less than 10% probability of failure is okay. Okay, I mean it's not really that bad, and we'll look at other scenarios of how do we manage if this 5-7% as well. Now, obviously, if you bring it down to 2%, then you're taking much lower than what income is lower, and obviously your probability failures is now almost 0% or 0.3, 0.4% for that kind of equity. Now, what this tells me at least is that this is kind of this whole thing is kind of the sweet spot of um, right. This is where the sweet spot lies in terms of your asset allocation, right? This part, okay? Because having much more equity than this is not really reducing your risk, actually increasing the risk, right? And so somewhere between this 3 60 40 debt to so 60% to 40% debt and the remaining in equity, depending on whatever kind of appeals to you. But that's what at least my analysis tells me this, where the sweet spot lies. Okay. Now we also just tested for 5%, and for 5%, obviously, the failure rates are very, very high. So it's not happening.
Yeah, Rajul,
Yeah.
uh,
Yeah.
based on this result, so should I conclude this way? From 5 crore, so we should expect a best point is 1.25 lakhs per month a income which we will able to generate, not beyond. Is one.
Not beyond that, right?
That is
Kind of that, right? And we'll see what to do, what can be done to improve
uh,
this probability, right? So it reduce the chances of failure. But yes, about 3% is the
uh,
right kind of thing you look at, and that's the kind of asset allocation that we need to have, right?
yeah. And second learning is from you is the 60-40 from is coming the depth and versus equity. That is something you suggest. Beyond that is not you are suggesting. So two learning coming from this testing, right?
Yes. So 1640 to 4060 debt. So some anywhere in between like this, right? Somewhere there.
But you said in a starting itself. But you said in a starting itself. Let's say, since we wanted a minimum risk over retirement, so you will prefer a 60-40 as time
As is
passes.
obvious, right? So this one is 5%, 7%, right? So I mean, I'm just saying these are not significant differences as such, right? Between 5 to 7%, it is less, but yeah, I it is giving at least that insight to us to say, okay, one, we cannot be 100% debt or we cannot be 100% equity, right? But a lot of people kind of come with a plan saying, okay, boss, if I just put everything in Nifty 50, right? And then I can just put a SWP against it and run. I mean, SWP is nothing but a 4% withdrawal rate, something, right? SWP is a defined. What is SWP? SWP is essentially a fixed withdrawal, right? If you go back,
Right.
this is what SWP is, right? Or this is SWP, right? Something that doesn't work is all I'm trying to say. Okay, at least in my testing, it doesn't work, right? It doesn't work blindly. So again, if you see around, this is the kind of
So now,
graph we get. Yeah. Yeah.
yes,
So
now
go ahead.
two learning has come clearly. If from 5 crore, we should expect 1.25 lakh. That is the right expectation. If we expect more, there is a risk more, as we said, and the failure possibility is more. And if it goes down, then you don't get a right returns 83 or 1 lakh. That's what you said. So
Yeah.
let's say from 1 lakh to 125. Let's say one rule. Second is the equity 60-40. Now coming back to the 60-40, then what is the way you want to suggest? Because you must have done the first.
I'll get to that. Yeah. See, I just wanted to show here, right? So this is kind of graph. If you just do an internet, we see smooth graphs like that. But reality, graph will more probably go more like this. Right, your portfolio will keep going up and down and up and down. It not goes like a smooth curve. Okay. Uh, Now, so what can we do to kind of further reduce this rate? Okay, the failure rate. What can be done to reduce this further? Okay, so that's also something I have tested. Just to remind, right? Now, this is what our ratios were. Now, what we introduce now is this. Okay. So without income, you get this. So now I'm going to introduce income into this, okay, to see what happens if I have out of that 5 crores, some part of it is actually an income generating asset, okay. And again, this is something I've been telling on the group, so let us say instead of everything 60-40, somebody invested a 10 lakh rupees a year for 10 years into a guaranteed income stream, the kind of scheme that I have been I've shared more than once in the group. Okay. So it translates to about a 1 crore investment. Let us say if instead of this, somebody was putting that money into an equity mutual fund with a 12% return, that would be about 1.75 crores. Could theoretically give you 1.75 crores. So what I do is I take out that 1.75 from the 5 crore, okay, and the remaining 3.25 crore is then split between this 60-40 whatever, and whatever income this guy is generating, this 1.75 crores is like 11 lakhs per annum for 24 years, and you get the return back in 25th year. So the total amount stays at 5 crore. Okay, and I've given the benefit of this, saying this 1 crore investment alternate, if I put that into mutual fund, would have got to this amount, and I've taken that out, and only 3.25 crore available now to split between debt and equity. Okay, and let's see what that results for us. Okay, so with that income of 1 point of this of 11 lakh per annum that I'm getting, right, you can see what difference it makes to the failure rate, right? It drops significantly. Now suddenly with this, because of this, I can look forward to a much higher income in my retirement than without this. Okay, and to an extent, if you just think about it, logically kind of makes sense. Okay, because a good part of our income is coming from, at least in the initial years, is coming from such a pension or such income generating scheme. Even if it is not keeping up with inflation, it is providing you with a cushion, right? It is providing us with a cushion that will allow us to, so though I have not taken that into account while doing this probabilities of failure, but you can imagine that with this kind of an income coming in, it gives a cushion in a bad year, right? In a bad year, to take much less from the, from the portfolio, because there's something that is guaranteed coming, or something is coming as an income, which probably puts the food on the table, and allows me to live that year without problem, right? But even without reducing my income, okay, or by any at all, my with income probability of failure has come down drastically. Okay, so that's another one insight that you get out of this equation, right? So therefore, and if you get, and if I haven't presented the 3% numbers, but with 3%, that number is even better, right? With the 3% and with income, that number would be even much lower, almost close to 0 or 1%. Okay. Now, with the with the bucket one again,
Sorry,
as I
Rajesh,
said,
in the
yeah.
previous slide, this 4% is only on the remaining 3.25 crore, right?
No. 4% is the income is the same. Okay. So income is this only. Let me show you. This graph has not changed. Okay.
Oh, okay.
This is 4% on the overall 5 crores.
Okay.
Okay. So 4% is on 5 crores. 4% is not on 3.25 crores. Okay. So that number is not changing. Okay. So 4% is on 5 crores. Only thing is, I split now the 5 crore into three things. Okay, so one is 1.75 crore, which is generating this income. Two, out of the remaining 3.25 crores, it is split into debt and equity. Okay, your income is still coming out of, so that's why in the here I've shown 1 point. So the income has not changed. Okay.
Oh, okay.
This income is the same.
Got it.
Yeah.
Raj, just to what is the reason you divided 3.25 and 1.7? I'm saying what ratio? Why this?
No. So I've not done. So it's just an example I've taken. Okay. So there's no. So it's basically saying, okay. So see, while I'm in my accumulation phase, let us say if I bought into this some of this guaranteed income scheme, which I think if you must be getting bombarded with those schemes, right? I've shared it a few times on the group.
Yeah, yeah.
So see how does that actually help, and how does it actually help? So instead of putting 10 lakhs in per year, let us say in a mutual fund, okay, I put that 10 lakh in this income scheme, okay. Uh, Given what it is given the kind of return it is giving right now, okay, what would it help, right? What difference would it make? So therefore, I'm saying 10 lakhs in 10 years, though I'm only putting 1 crore, right? 10 lakhs in 10 years is only 1 crore. But I'm saying no, no, no. But if I had put that money in a mutual fund, I would have got 12% return or 10, whatever, and then that would have actually given me much higher number at the end. So 1.75 crores, right? So that's what I'm taking. So even though my investment is only 1 crore, I'm actually assuming it is 1.7 crores, 1.75 crores, because that is what it would have been if I had put money in a mutual fund, okay, or some other instrument, okay? And therefore,
But
yeah.
Rajul, what I'm saying, this may not be starting. What I'm saying, for us, the starting point is a 5 crore. See what you're saying.
So yes, it is still 5 crores only. So 1.25 here, right?
No,
1.75 here and 3.25 here is 5 crores.
okay. I'm just that example is the earning example. I'm saying for a retirement starting, you have some corpus. I'm assuming 5 crore. You have to decent life to spend. You need a 1.25 like per earning part from there. And the 3% rate which we have tested is the optimum rate for in terms of the risk.
Yeah. So correct. So that's if without this, right? So okay, without the income scheme or without any asset that actually generating income for you, right? In a direct in a like a monthly or annual income
Right.
that's coming to your account, right? So that is simply putting money in a bank FD and money putting in let's say Nifty 50 index fund, right? That's the 3%. That's where the 3% coming from, right? Now, how do you? So the question was a question I put: how do I improve that? Either improve the withdrawal rate or I reduce the failure percentage. Okay, so even with even with 3%, there was a failure of 5 to 7%, right? So how do you reduce that, or how do I? If I say 1.25 is not enough for me, or I don't have the 5 crore, okay, I only have 4 crores, okay,
Right.
then what do I do? Okay,
No,
so so I'm saying
one
even with that 5 crore, if you generate, if you create assets during while we are still in a phase for retirement, still in the accumulation phase, if you start creating some assets that generate income for you throughout your or for most part of your retirement, there is value in doing it. Okay, provided that thing actually gives you a good yield, right? Even otherwise, obviously, a lot of people think, put money, into rental and all that. Of course, rental yields are much lower, and it is not that tension free as let's say a pension scheme or this kind of a scheme where you don't have to do anything other than buy this, right? Your money will keep coming in your account every year, and you don't have to maintain anything, right? So just wanted to give that as a
So what it tells you is that if you don't, I mean, the previous present slide was telling you that if you don't plan anything, and the day you retire, you just have that 5 crore corpus, then what is it that you can withdraw? What is the comfortable withdrawal per month that you can take without adding too much
yeah.
risk on you? But the second slide is telling you that if you just plan 10 years ahead and you invest in some guaranteed income scheme, then it can simplify your finances in a big way. You can earn the similar kind of income uh, with a much better chance of success, for your
Absolutely.
retirement.
Okay, let us see if this is any good. Hmm?